Welcome to Investors Insights. Our topic today, unnecessary fear. We chose that topic because with the volatility that's gone on in the markets, all the discussions going on in the media, we thought it was appropriate. And we believe in tracking the facts, looking at the data. So with that said, I'm joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. Gentlemen, good morning to you. It's great to have us all together here. The meeting was outstanding. A lot of interesting facts. You guys have done some incredible research, especially with uncertainty out there. With that said, unnecessary fear. Bobby, a lot of talk about interest rates. Let's discuss that. Tell us what you're seeing on the research side or the points you brought up in our meeting.
Yeah, so we continue to get a lot of questions about an emergency rate cut due to the worries of an economic recession coming. So I want to share why we think all that talk is pretty much premature and why an emergency rate cut isn't happening. So the Fed's dual mandate means it monitors both inflation and unemployment. Encouragingly, U.S. initial jobs claims actually tick lower to 227,000 this week. And there are other signs of momentum. So, for example, last week, U.S. retail sales surged 1% month over month with a rebound in autos in July. That is a great surprise to the upside. I also want to share 4 charts from the NBER, or what's called the National Bureau of Economic Research, that shows where certain leading economic indicators have historically been in previous recessions. You can see that in employment, industrial production, personal income, and manufacturing and trade sales are all well above recession levels seen in the gray bars there, with industrial production being really the only indicator that has kind of turned down in recent readings. But bottom line is this: the U.S. economy overall thus far has been robust enough to take an extended Fed rate pause. And so, yes, small cracks in the economy mean there's a clear case for a Fed rate cut soon, but there's no immediate concern that would justify an emergency rate cut or a jumbo rate cut using or looking at today's economic data.
So we could have a lot of hype out there in terms of news media, is what, in essence, you're saying. You agree with me on that?
Yeah, that's correct. It's unnecessary fear.
Yeah, unnecessary fear. Absolutely. And then, Trey, I always nerd out. As you know, I love to talk about the Fed and rates and all those things. But you brought up some great examples in regards to the Fed and what they're looking at in relation to rates and unemployment, jobs. Elaborate on that in relation to what Bobby just shared with us.
Yeah, absolutely. Thanks, Greg. Yeah, so as Bobby said, the Federal Reserve, when they're making interest rate policy, when they sit down and meet, they have two mandates. So they're trying to achieve full employment and stable prices, which is low inflation. Those two conflict. Obviously, a strong economy that brings in full employment can cause prices to go up. And so they kind of have a tough job to try and keep both of those paths on track. And what happened over the last few weeks is we've made a shift. And I think people that have been watching our vlogs over the last few years have heard us say this a lot of times. The Fed may have a dual mandate, but they've really only been focusing on that inflation mandate. When the inflation numbers came out, the market reacted, shot up or shot down if it was better than expected or worse than expected. What happened on the first Friday of this month is that the jobs data came out and surprised worse, and the unemployment was higher at 4.3%. You can see on this chart, the orange line is the unemployment rate, the purple line is the inflation rate, and we've seen a divergence of the two, where inflation has come down while unemployment's gone up, and so that's a shift in the guard on what the market's going to be watching. The market will now likely be watching what they expect the Fed to watch, which is unemployment. And so we're going to have 2 unemployment reports between now and the next Fed meeting in September. Those will be very big market-moving data points. Is unemployment getting worse? The trouble is if the Fed's focused on employment, they're not focusing on inflation. And while inflation's coming down, the last print was 2.89. That's well below the peak of 9%, well below the peak of almost 3.8% in the last year. but it's still not at that 2% goal. And the reason the Fed sets that 2% goal is because it's difficult to get to and it's hard to maintain, but that's their goal. And so if they take their eye off inflation, does that cause inflation to spike back up? What will cutting rates, if they cut rates because they're watching unemployment spike, will lower rates cause inflation to come up at a time when unemployment's going up? And so it's this handoff of the dual mandate that's got the markets a little concerned and some volatility. We think that'll likely continue, but that's kind of the transition we're having. I pulled this chart up from mid 76 to beginning of 77. You can see inflation was consistently going down while unemployment was staying stubbornly high. The Fed shifted on its mandate and it caused inflation to roar back up. And so something we're always watching is using history as a guide, and this will be a key turning point potentially for what the Fed is doing in terms of inflation and their mandates.
No, it's a great explanation. And, of course, I remember the quote we use around here often, history doesn't repeat itself, but it sure does rhyme. We're hoping the Fed doesn't make the same mistake they made in the 70s and on into the early 80s there. So we're watching that very closely. I also appreciate, I had a few calls from clients thanking us for these vlogs and also the podcast, as well as what we were posting on social media, where we're just keeping them updated as things continue to develop. We're going to keep you updated about as the Fed's making their decisions. And on top of that, with the emotion out there, and also in relation to our theme, unnecessary fear, the volatility that we've had in the market, there's actually an indicator to follow called the VIX. And Ty, you really drilled down on that this morning. So, with all the information that Bobby and Trey have provided in terms of data and facts, talk about the VIX in relation to the market and how it's reacting to some of this news.
Yeah. And so, volatility, we all remember August 5th, not that long ago, 2 weeks ago, the yen carry trade, the employment report really had a lot of market pressure for that one day and kind of, a little bit throughout the week, but mainly that one day. And Bobby and Trey have done a great job in the past couple of weeks of touching on, volatility is normal, and it completely is. But one thing that is kind of unique to this situation is the rate of change. And so I'll kind of start with the VIX here. I have a chart of the VIX. And so the VIX is the CBOE volatility index. It's also called the fear index. And so it essentially measures the rate of change in the market. However, volatility is typically only measured on the downside, not really the upside. So think if you have a negative 3% day in the market, the volatility is going to spike. If you have a positive 3% day, volatility is not really going to spike. And then if you have, a 0.5% day or a 0.25% day, there's really not much going on. It kind of just flatlines. And so in this chart, you can see this big spike that we had on August 5th, went all the way up to, about 38 or so, 38 and some change. And now we're down back to a more normal level, or at least normal here for what we've seen for the year of around 15. And so you may think, wow, that's a big change from just, 2 weeks ago. And you would be right. If you look at this chart here, it actually shows that now this chart ends on August 15th. We're about the same level now, but we peaked at 38.57, what was our starting point for the day, around August 6th or so, August 5th. And then we're now at 15. So the volatility index has dropped by 61% almost. And if you look at this chart, that's the biggest rate of change in such a short period. That's 8 trading days. But also, notice all the green on this chart, the performance after a volatility spike. Typically, you may think, well, that's a sign of things to come. And it doesn't mean it can't be. But one thing that, is pretty apparent is that when we get this big volatility spike and then it comes down pretty rapidly, it's almost like a kind of temporary scare. But then we have some great performance leading out 1 month, 3 months, 6 months, all the way to 5 years. And so again, future results don't have to mimic, this past performance here. But anytime we've had a drop, somewhat on this level, it's been a positive market, considerably after.
Todd, thanks for that insight on the VIX. And to our viewers, I hope it gives you insight, what you've heard from Bobby, Trey, and Ty, as to the data, the information, the facts that we're watching each and every day, regardless of how things become so emotional. And we'll continue to keep you updated, not only like this, but in our phone calls, our meetings, one-on-one, and all the other ways we communicate, Facebook, Twitter, LinkedIn. We hope you have a great week and know that we appreciate each and every one of you for believing in us, and we're striving every day to see to it that our clients' lives are better, richer, fuller. Thank you.